the different asset classes of distressed real estate and how you, as either active or passive investors, can participate in those as you move forward within your world as an investor. So what we're going to cover during the course of this next hour is what is going on in real estate on a nationwide basis after the real estate bubble. What exactly is a distressed asset, and what are the various asset classifications? I'm sure many of us have heard of some of these, but there's a lot of them that Brad's going to be talking about that many people are not even aware of or are not truly aware of how to truly capitalize on those. The pros and cons of each, as well as where you can find these things. And sometimes they're in your very own backyard. Other times there's hotspots around the country, and we're going to talk about that too. Our friends at iPlan Group are going to talk about some financing strategies and what we can do to go on from there. So Brad, as far as the national landscape, what are you seeing as far as trends right now?
Well, right now is an exceptional time to buy real estate. If you look at, the nation on a historical basis, if you go all the way back to, let's say, the Great Depression, you'll see that real estate runs in 7 to 10 year cycles, and we are in the beginning of that 7 to 10 year cycle, and we're seeing a major uptick in every market. Properties are appreciating, the good inventory is being gobbled up, and we're looking at a very positive 5 to 7 years of continual growth in the real estate market. So right now is really a great time to buy, and you're able to get them at prices that we haven't seen in a number of years. But that window of opportunity will close, as these properties get purchased up, and prices will rise, and we will get back to the high levels that we were a few years ago.
Yep, and also we're going to start seeing the horizon of a lot of these federal government programs for the folks that are going through their upside-down nature of their loans and what have you. So that's going to come back full swing, really opening the door even more for investors to purchase properties. And as many of us are probably aware, the millions of people impacted that are now renters are going to be some of our best sources of revenue in investment properties when we're looking to buy and hold. And certainly there's never been a better opportunity for buying and flipping, even though that kind of slowed down a bit when the big institutional buyers came in. There's a lot of opportunity for private individuals right now. And I would like to say one thing. The information that we're going to share with you is available to everybody on foreclosure.com, and Aaron will be sharing with you a special offering that we're making to everybody there as well if you'd like to utilize that same data. So let's go ahead and take a look at some of the details that we're going to be talking about in today's webinar. And I think the first thing we should really cover is what exactly is a distressed asset. In terms of the banking industry, a distressed asset is a property that has financial hardship, and that is a property that has missed several months' mortgage payments, putting it into default, and in many cases pre-foreclosure or even into the foreclosure process. But that's from the banking perspective. As investors, we see distressed assets from a completely different angle of attack, including that same philosophy, but also looking at other cases where the owner may be current on their mortgage but still show signs of being distressed. And we can help them as investors with a win-win, helping them out of that situation, solving their problems, and at the same time being able to create profits for us on the buy and sell of real estate. So distress can be physical, such as a property that was vandalized after it was vacant for a number of years, or just financial, or a combination of the two. And we're going to share with you some of the varying degrees of complexity with certain types of investments and some of those that are very simple, and what we as investors, or you as investors, should be considering when making these purchases. We'll also share with you some actual case studies that we've been involved with in the last year, just a handful of them, that are both flips as well as buy and hold. Brad, did you want to say anything about some of the numbers?
Yeah, so right now in the country, there's about 3 million properties that we consider to be distressed assets that we look at as great opportunities to purchase. There's a number of different types that sum up to that total, and what we're going to do here is we're going to walk through each one of them and explain what they are, what the opportunity is, and show you an example of an actual sale and transaction that we've done with one of those in the recent months.
Very good. And we can spend some time on these and really get into some of the details.
Okay, so the first type of a distressed asset is a short sale. Now, I'm sure everyone's heard about short sales. And basically, a short sale is a property where an owner is in default. They're either behind in their mortgage payments, or they're upside down, meaning that they owe more than their property's worth. And what the owner is doing is they're trying to sell the property before it goes into foreclosure. So they're financially distressed in the fact that they're under pressure, that they're in foreclosure. But the owner gets an offer, they present an offer to the bank, and they negotiate with the bank to settle for a lesser amount and have the bank discount the property. There's good news on the short sale front is there's a lot more organization in this part of the banking industry than there was several years ago, where short sales took a long period of time. We've actually just launched a new technology for Fannie Mae where the short sales are submitted right online and they go in for a quick 48-hour approval. So short sales are great opportunities. They, you may have heard that they take a long time to close, but that's improved a lot. And we look at short sales as great potential buys.
Yep. And there's a couple of considerations with short sales that are rather different than a lot of other investments. One of those, the banks require those transactions to go through real estate agents. So if you've got a friendly neighborhood realtor, that would be the way to go with those things, and that's just one of the regulations. And Brad mentioned something that was really important too, and as part of what we talked about earlier with the complexity of deals, short sales by definition mean that whoever the lien holders are, whether it's the first mortgage, a second mortgage, or even a home equity line, why they want realtors in there is to help negotiate those transactions. And as an investor, what we look for, and we're going to share with you, a couple of case studies, we look for properties, if they're short sales, that only have one lien against them, such as a first mortgage with Chase or Bank of America. That way we don't have to worry about having to pay less to a second mortgage holder or an equity line, which oftentimes causes those deals to not go through. So the smart investor looks for those single lien properties where we know that the bank has regulations in place that they're willing to follow.
Now, on your screen, you see a map with a bunch of purple little tags. That's a map of actually, it's a live map from foreclosure.com, and those are short sales, within proximity to where we're at. We're in South Florida, in Boca Raton, and those are short sales in Boca Raton. But we have short sales nationwide in every city across the country.
Yep. In fact, I guess it would be great to say at this point, if you happen to have a moment later on this evening after the webinar, we'd encourage you to go to foreclosure.com, type in your zip code or city, and look at the different asset classes we're going to be covering during this webinar, and you would be shocked in most cases to see exactly how many of these things are right in your own backyard. In fact, in our marketplace, there are literally thousands within a square mile of where we're located of the different types. It's just truly amazing once you peel back the layers of the onion. Okay, let's take a look at an example of a short sale. This is one that we did back in 2007. It was right when the bubble had come to its end. The property was originally, purchased in 2007 by the original owner at $600,000. We came in and purchased that at $250,000 in 2011. Now, bear in mind, the loan balance is almost $500,000. So the owner came in with a 20% down purchase. We came in at $225,000. It was actually listed at $225,000. We were able to purchase it for $250,000. And at the time, it had an appraised value of $317,000 for a $67,000 equity position. Now, two very interesting things since that. The property remains great cash flower. It does have ocean access waterfront with a deeded boat slip, and they've been appreciating annually about 15%. But we also just found out in 2013 that there was a 20-year lawsuit being settled with the airport and the city of Dania Beach that apparently had just gone through, and each of the unit owners will be receiving a settlement of 21.9% of the property value. So that's going to be another $70,000 plus that comes in straight off the cuff.
Absolute home run.
That was a windfall.
Now you notice on this one, the property was listed at $225,000, but we ended up buying it for $250,000. The reason is you make an offer to the bank, and our initial offer was $225,000, and they negotiated back and forth, and they wanted $300,000 for it, and we went back and forth, and we ended up settling at $250,000. So that's why the purchase price is above what we actually what it was listed for.
Yep, and that was a good buy and hold. That could have easily been a flip just as well. All right, Brad, pre-foreclosures.
Okay, now a pre-foreclosure is a property that is in the process of being foreclosed on. Now what that means is it means that the owner of the property has stopped making payments, and the bank has actually filed a legal process to foreclose on the property. So a pre-foreclosure is a great opportunity. The difference in a pre-foreclosure and a short sale is the pre-foreclosure is in the foreclosure process, may or may not be for sale, and we reach out to these homeowners and say, hey, are you interested in selling their home? And if they are, then we make an offer. If a pre-foreclosure is upside down, meaning they owe more than it's worth, then it's a short sale. If they have equity in the property, then we consider it a pre-foreclosure, and then we buy it directly from the homeowner and pay off the loan.
Yep. And probably pre-foreclosures and understanding the foreclosure process is more complex than a lot of these other transactions that we're talking about, because there are a number of different milestones along the way from the time that the homeowner is served their notice of default. And that, by the way, depends on whether it's a judicial state or a non-judicial state. And so there's a whole bunch of stuff. We do have information available if anybody's interested. And I know the iPlan group wants to do a deeper dive session for anybody interested. We'll cover that in a lot of detail as far as, all those steps and where your best opportunities come in.
Now, if you look at the map on the pre-foreclosures, this is our office here, and you can see how many pre-foreclosures there are. So pre-foreclosures are everywhere, every city in every part of the country.
Absolutely.
And you'll be amazed at how many there are. You could be looking in a subdivision. You may have a certain area you want to look at properties, and you'll see that there's pre-foreclosures all over that neighborhood.
Yeah, you can also see in your neighborhood which one of your neighbors may not have been making mortgage payments if that's something of interest to you. So, it's always something of interest out there. Okay, so here's an example of a property. Again, this is here in South Florida. That was a pre-foreclosure in Royal Palm Beach. This one was purchased back in April of 2013 for $160,000, so it was a really steep discount off the list price. It needed absolutely zero renovations. This house was completely turnkey, as you can see from the interior pictures, and it sold 2 months later for $245,000 with a net profit of $62,900. It's important to note, however, that the person that bought that, so we sold that almost as a wholesale, the person that bought that resold it 5 months later for $320,000. So they got an amazing profit themselves on top of that. It makes you wonder sometimes whether you should hold it for just a little bit longer. But as an investor, oftentimes the money in and the money out is really smart money if you can keep that money moving.
I believe you never go broke making a profit.
That's a really good point, Brad. And one of the things that's interesting to know too, and that we are firm believers in, particularly when working in partnership deals, is if we can take that money and turn it more than one time in a year, that 30% rate of return can turn into 60% or 70% or even a multiple of the money that's invested. And that's where real estate investing really becomes such a smart angle of attack compared to other forms of investment such as mutual funds or stocks, particularly where one feels like you're gambling, as I know I do when I invest in the stock market. That's why I like the bricks and mortar personally. So this was a really great deal. A lot of these, by the way, are also in association, so you don't even have to deal with external maintenance on the property. The lawns are upkept, et cetera. So there's a lot of neat things.
Always a plus.
Yep.
All right, so the next type is a foreclosure or an REO. A foreclosure means the property's actually been foreclosed on. It's gone through the whole legal process, and the bank actually owns the property at this point. Now, the reason they have the term REO is back, number of years ago, banks did not want to admit that they had foreclosures, or it was sort of bad for the reputation of a bank. So the banks started to call them real estate owned, and they would market them as real estate owned, and that's where the word REO came from. But an REO is a foreclosure, and these are great opportunities because the banks do own them. They want to sell them. In most cases, the banks will do minimal repairs, bring them up to standard, and many times you can buy these properties directly from the bank. They're pretty much turnkey, ready to go, clear title, just ready to either rent or resell. You can see, if you look at the map, this is the same map. Look how many foreclosures there are. So, I mean, it's pretty amazing, the inventory.
Yep.
And the opportunities that are out there.
So I think this would be a good time to kind of recap a couple of things, Brad. And you mentioned the banks, which is really an important aspect in virtually every type of distressed sale, with the exception of one that we're going to cover. What are you seeing, and I work with you, so I'm kind of asking this rhetorically, but in terms of the banks' methodology, where they're at in terms of liquidating inventory? Are they throwing it all on the market right now as fast as possible, or are we seeing them hold any of it back?
Well, you know, there's some inventory that the banks do hold back. You know, there's another type of property we're going to be talking about here in a minute called shadow inventory. But, you know, they do hold some of them back. But for the most case, you know, the bank does want to put them on the market. They want to sell them. The foreclosures are going to be the most difficult to negotiate with, in the sense of the banks have gotten a lot smarter. And, you know, when I say they've gotten a lot smarter, with this big boom in foreclosures, the banks have learned, you know, that, hey, there's money to be made here. And, you know, they've gotten a lot shrewder. They've all become real estate experts, in the sense of they have properties now and they want to sell them, but they want to sell them and get the most out of them. So, you know, the foreclosures are great if you want to buy something that's turnkey. But what we find is that the margins on these foreclosures are they're lower than, let's say, these other ones that we're talking about, because, you know, the bank owns them. They're going to try to hold out. You're going to try to get the best number they can for them.
Yep. Now, there's a couple of things that are pertinent on this particular slide that also apply to some of the other ones that we've been talking about. And one of those is whether you're buying as is or with repairs. Now, in traditional real estate, when you're buying a retail house that's for sale, oftentimes as the buyer, whether you're going to live in it or buying as an investor, you have the option to request repairs be made, or that you can have inspections done on the properties. With any of these, you can still throw inspection clauses in there that allows you as the investor to say, look, I'm not sure what the condition of this property is underneath the roof rafters or under the floor joists, so I'd really like to have the opportunity to be able to do inspections on these properties and know exactly what I'm getting myself into. That is super critical when buying as an investor, so that you know what your going-in acquisition cost is going to be, ultimately what your rehab or repair costs are going to be, and having a really strong idea of what your resale is going to be, so you can really calculate that profit, and you're not a guessing game. You know all these facts going in. But those inspections are really critical. In many cases, however, the seller, if they're distressed homeowners, or the banks, will not put more money into these properties and make repairs. So it's important to understand what that you've got going in. And Brad, as far as working on repairs, GCs, handymen, any thoughts on which you prefer to work with?
Well, when you hear, we have to renovate a property, it doesn't mean that you have to go and buy a hammer and a saw and actually go out there and do it yourself. I mean, we sub everything out. And, if we buy a property that needs fix up, in most cases, the majority of the properties that we buy, they're mostly what we consider to be cosmetic repairs. And we're able to do those repairs with a handyman. Handyman comes in there and fixes all the broken things and does painting, and we put new flooring in, we change the appliances. There's two different type of properties, ones that need minor repairs and ones that need major repairs. And I would recommend, if you're not construction savvy, to stay away from properties that need major repairs and focus on the ones that need minor repairs or that are turnkey.
Yep.
It takes a lot of the headache out, makes it easy. There's a lot of inventory out there that's in decent condition. I love properties with cosmetic repairs. Where the home itself is all structurally sound, but it's dirty. I love dirty houses, and I know it sounds funny, but a dirty house, you can go out, you can paint it, pressure clean it, put some fresh shrubs in the front yard, throw some fresh grass down, and you can turn an ugly house into a diamond very easily and quickly. And that's where we see our biggest profits and our biggest margins, are these dirty houses.
Yep. And I think you're going to see a bit of a theme going through here, that there's really several angles of attack. There are those properties that, as investors, we'll talk directly with the homeowner, and then others where you have to go directly to the bank. And there are opportunities and pros and cons on each side of those. And as we get more involved in this process, and as an investor, especially if you're going to be an active investor buying for your own purposes, it's great to begin to understand some of the motivations behind those folks. As a passive investor, you would rely on your team to handle all of that skill set. So really good stuff, and it's good to know. Last but not least, vacant or with tenants in place. When the foreclosure epidemic happened, there were a lot of tenants that were in properties, and so there was some legislation that passed that enabled the tenants who were in place, provided they were lawful tenants, they weren't squatters, they were either on a month-to-month lease or an annual lease, to be able to fulfill the term of that lease unless the tenant wanted out, in which case there may be opportunities to offer them some kind of a cash for keys. I always tell Brad I've been able to spot squatters pretty easily. They're the ones with the really big thighs. He says I should never use that joke again, so that'll be the last time. Okay. And you're the audience that's hearing it.
You know, a great thing about buying properties that are already rented is it takes a lot of the risk out. You know the property is in habitable condition. You have a tenant in place. You're basically buying a property on a cash flow. And, you know, what we're seeing as an average, you can buy a rental property and get somewhere between a 10 to a 15% return on your money, cash on cash. Sometimes we see them as high as 18 to 20, but, you know, for the most part, they're in that 10 to 15% range. And the nice thing about renting and holding a property is, you know, you have a lot of expenses that you can deduct. There's a lot of tax advantages to it. And in the market that we're in now, we're anticipating, you know, consistent and solid appreciation. So, you know, over the next 5 to 7 years, buying a property, renting it out, and holding it is a very wise move, and should be a good return.
You know, you reminded me of something, Brad, since we're talking about banks, et cetera. Another very important factor to consider when it comes to short sales, and I know we're going back a topic, but I think it's important for the audience. In 2000, a law basically that was called the 2007 Mortgage Forgiveness of Debt Tax Act. And what that basically said was any homeowner who either went through a foreclosure and ended up having debt forgiven. In other words, they owed $500,000 and the home sold ultimately for $200,000 on the foreclosure steps, or through a short sale, same scenario. They owed $200,000 and the home sold for $100,000. Under normal circumstances, that forgiven debt would be perceived by Uncle Sam as income. And so that $100,000 or $200,000 forgiven debt could result in a $30,000 or $60,000 tax consequence for the homeowner. And that was in place through 2012, and it was extended one more year by Congress through 2013, December 31st, 2013. That has not been renewed at this time. So for people who are in a short sale situation or maybe going through foreclosure, there are some real ramifications for them right now. And that's where, again, as an investor coming in and finding that winning solution where we can have the terms of that transaction a little different than forgiven debt, those homeowners will have a great opportunity to be able to walk away. Now, without getting too deep on that, there are some IRS codes, and I'm not a CPA nor am I a tax accountant, but IRS does have some code in there for individuals who were insolvent at the time debt was forgiven, meaning they owed more than their worth in cash, that they can still get that done, but that requires a proactive step on that individual's part in working with their CPA to make sure that they don't get a tax ding on that. And then the last piece on that with short sales is that there's also the issue for homeowners that sell, or investor owners at that time, if they had rented property, that they need to be very careful about not deficiency judgments for that debt forgiven, et cetera. So those deals can be a little bit more complicated. I just want to share that. All right, so let's talk about another one. This one is actually under construction right now. This property was in Delray Beach. If you folks have been listening to the entertainment news, Delray Beach has become a real hotspot for celebrities like the King of Queens, Kevin James, and Adam Sandler have all been buying properties there. This particular house was purchased in October for almost $500,000. This one was pretty rough. It required $200,000 in renovations, and we're expecting that one to sell for about $1.05 million. After closing costs, we're looking at a $250,000+ profit. So it's important to note when it comes to real estate investing, in particular when you've got lots of inventory options, and we're going to talk a little bit about where some of the hot spots are, that you don't always have to have a $250,000 profit. Sometimes getting in and out for $10,000 profit, as Brad mentioned, you can never go wrong making a profit. And there's oftentimes deals that we'll look at where we may go in and just wholesale the property if there's a buyer ready, willing, and able to take it in its as-is condition. So more good stuff when we take a look at that. Okay, another type of property is a sheriff's sale. Now, a sheriff's sale is once a property goes through a pre-foreclosure,
The last step of the pre-foreclosure process is the sheriff's sale, where the property actually gets auctioned off at the courthouse. And this is where you have an opportunity as the public to bid on that property and buy it. Now, if the property doesn't sell at auction, then it goes to the bank, and then the bank is the proud new owner of that property. Now, what we see in a sheriff's sale is only the properties that have equity in them will sell at this stage, because you're buying it, at a discount, and it's satisfying the mortgage. If the mortgage amount is more than market value, the bank will bid up to their mortgage balance and ultimately end up being the owner of the property. So this is another great stage. One of the problems with this stage, though, is it is very competitive, and you are buying the property somewhat sight unseen, in the sense of, the owner, and usually if a property gets down to this stage, it's usually the owner is a hostile owner. They're not going to let you in the property. They're still in there. Their house is being auctioned off. They're in total financial and mental, stress and distress and mental stress. And so you're buying the property sight unseen. So there's a lot of risk at this stage. This is not one of my favorite stages to buy. It's a very popular stage that a lot of real estate gurus talk about, but it's a very complicated and risky stage.
Yeah, I couldn't agree with you more. In fact, truth be told, this particular one was not one that we picked up. We would have bid on this one, and it's kind of interesting. This happens to be somebody that we know personally, and that's why we want to talk about this particular slide. To make the right kind of returns on this, we would have wanted to have been in there for less than $125,000. So you can see that there was, at that time, I did a screen capture, there were less than 10 seconds remaining. That property ended up selling for about $135,000.
Yeah, and we had made an offer to the bank and a short sale on this one for $120,000.
Yep.
And the bank didn't accept it, and they were smart. They got more money at auction. Mm-hmm. But this one was right down to the wire. And what you end up finding, if you're negotiating a short sale and they're only a few days away from owning it on the courthouse steps, it's usually hard to put a deal together. The best time to hit a short sale is right when it goes into the process, because the bank knows, oh, there's a year before they're going to get title to this, so we better take the short sale.
Absolutely. In fact, courthouse steps is a great word. You can tell we've been in this business for a while. More and more, you're finding that the sheriff sales are occurring online. Although I've got a good friend who's buying real estate in Atlanta, and I just saw a YouTube video where he was bidding on the courthouse steps still.
So it's still out there and around.
Yeah. So here in South Florida, we go online, and you can do the same thing. In fact, if you want to become more and more savvy about these auctions, go online to your county courthouse website, and usually you'll find real estate auctions. You can create an account for yourself. It's free. If you want to actually bid on properties, in most cases you'll have to put some money into an escrow account with the county, and that should typically be somewhere on the order of 5 or 10% of what your proposed bid would be. So if you're planning on bidding $100,000, depending upon the rules in your county, you'd have to have $5,000 or $10,000 sitting in there. It's fully refundable unless you actually buy the property. Then it's fully not refundable, even if you back out of the contract afterward. But they're pretty interesting deals. One other thing that I think it's important to note on this particular case is that when you're buying at auction, you need to be ready to fund it within 24 hours typically. Would you agree with that, Brett?
Yes. Yeah. You have to have cash and quick closing.
There you go. So the next piece, of course, will be auction. So you can take a look at how many of those there are in any given month.
Yeah, so now when we talk about an auction, we're talking about where a bank is actually auctioning off a foreclosure through a third-party auction company. Now, this is a highly competitive phase to buy, and you can see there's not that many properties. They come, they go. There's pros and cons to an auction. The difference between this type of an auction and the sheriff's sale auction is these are professional auctioneers. And if you've ever been to an auction, it doesn't have to be real estate. You could be buying, antiques or whatever. You usually see that the auctioneer drives the price all the way up to market or above. So they're very competitive. They're very high pressured auctions, and there's also a lot of auction fees, like a buyer's premium and whatnot, that really add on to the deal. However, if you spend time and go to enough of them, there are opportunities to be had at these auctions.
Yep.
But this is also, you know, we have all these auctions online. They come and they go because they're all time sensitive. They're all dated as far as, you know, when they're available. And you can see, you know, view them, which ones are in your area.
Yep, and you know, when you talk about the auction fees, maybe it's important at this time to bring up when investing in real estate, as both the buyer and the seller, you know, there's always closing costs involved. If you're financing as a buyer, you've got mortgage closing costs, but even if you're paying cash, closing costs include things like title insurance and recording stamps to record the deeds and all of those things, as well as when working with real estate brokers, if there are real estate brokerage fees, and those vary across the country, but typically run around 6%. So you need to factor that into your acquisition as well as your sale costs. And as Brad mentioned, when it comes to auctions, there are even additional fees such as buyer premiums that you would have to pay over and above, and the auction fees. And Brad, typically how high do the auction fees go to the seller?
You know, they're usually like anywhere from a 5 to a 10% buyer's premium.
Yeah.
You know, and 10% is a very common number. So, you know, if you buy a property for $100,000, there's a 10% buyer's premium. You have to pay $110,000 for it.
Yep.
And it's sort of a tricky way, you know, to get you to pay more at the end because most people aren't adding it all together when they're bidding.
Yep. And as Brad mentioned, they are run by pros, so their job is to get the most money possible off of those deals. And they're either done online or they're done also in big conference rooms or you know, the hotels. So lots of different ways to look at properties on auction too. All right.
Now tax liens, this is one of my favorite. Tax liens get me excited, and you can see how many tax liens there are, you know, just in a given neighborhood. When I talk about tax lien properties, we're not talking about buying a tax deed or buying a tax lien. That's a different type of real estate investing where the owner of the property is behind on their taxes, and at the end of that year, if the owner doesn't pay them, the government sells a tax lien to an investor so that the government can get their money and do what they need to do. And the investor holds that and is paid an interest return anywhere as high as 18%. Well, actually, I'm sorry, in some areas it's up as high as 35%, Chicago and different areas. But they get a return on their investment. And then if after the second year goes by, the court can sell the property, auction it off, and if nobody buys it, then the person that bought the tax certificate is now the new proud owner of the property. That is not what we're talking about here.
That's a long shot.
It is. Very few of those go down to the property, and the interest rates start at those high percents, and they get bid down. And it's also a competitive market, but it's also a great way of you know, locking in a return. It's a very secure return if you're buying it on a property that's free and clear, and there's a lot of benefits to it. What we're talking about are properties that have pending tax liens. Now what I mean by that is it's a property where the owner has not paid 1 year or 2 years of their taxes. And why is this why do we see this as such a great opportunity? Well, let me explain this. Properties with pending tax liens usually are free and clear. They don't have a mortgage. And the reason for this is if you have a mortgage with a conventional mortgage company, the mortgage company will escrow your taxes, and at the end of the year, they pay the taxes for you. So every month you make your payment, they're escrowing the money, and at the end of the year, they pay the taxes. So in order for a property to have a tax lien on it, meaning the owner didn't pay the taxes, is usually that property is free and clear. Now, there are some cases where there's private money or it's a small lender or something, and they don't follow the they don't pay the taxes, and it's and they do have a mortgage on it. But the majority of tax liens, 2/3 to 3/4 of them, are free and clear. Now, why is this so important? Well, when an owner doesn't pay their taxes, that is the first sign of financial distress on a property that's actually free and clear. And why that is so important is when you look at like a short sale, you know, there's two key factors in buying a property. One is you have to have a motivated seller, and two, the seller has to have the ability to sell you the property at a discount. Let me explain what that means. On a short sale, the owner's motivated, right? They're in foreclosure, they're behind in their payments, they're under all sorts of distress, but they don't have the ability to sell it to you at a discount because they owe more than it's worth, and they have to get the bank's approval. Well, on a tax lien property, you have a property that was free and clear. The owners obviously hit some kind of financial situation because they didn't pay the taxes. And reaching out to these owners and contacting them and expressing interest in buying the property, you know that you have an owner that's in a distressed situation. There's some reason they need to sell it, and there's great opportunity to be negotiated on these properties. What we find, and there's also a similarity that if an owner is behind on their taxes, they usually neglect some of the maintenance. So a lot of tax lien properties are what I was calling them dirty properties, and I love them. They're just great. They're just haven't been maintained. They look dirty, but they're so easy to go in there and clean them up. So the difficulty with the tax lien is the house may or may not be for sale. We publish all the tax liens, and you can pull them up on foreclosure.com and see which homes in the areas haven't paid their taxes, so you know that they're in some type of financial distress. The difficulty is you need to reach out to those owners, and you reach out to them and express interest. Hey, I'm interested in buying a property. Are you interested in selling? And if they are, you have a great chance of negotiating an exceptional buy. So tax liens are my favorite. They're very, very rarely talked about. Very few real estate investors even know about them. Most people think, oh, they're tax liens. I don't want to buy tax liens. That's not what we're in. We let everybody else buy the tax liens. Yeah. We go for the properties. And, a lot of these owners, properties have been passed down from generation to generation. So the third generation or whatever inherited the property. They have them. And they don't make the money like their parents or their grandparents did, and all of a sudden they're not able to maintain it or keep it. It's such a great source that nobody looks at. I call this endless inventory with no competition.
Yep, absolutely. In fact, we just came from a conference. You may have seen it on a previous slide, but in Las Vegas on hard money lenders, and these are very savvy lenders with very savvy investors there. And Brad talked about some of this secret inventory, and I was personally amazed that most of these folks had no clue. In fact, when he mentioned tax liens, you could almost hear the groan in the audience thinking that we were going to talk about certificates, and then all of a sudden the light bulbs went off. It was a major epiphany for these folks. And these are people that we even do transactions with. We have them as partners in some of our larger acquisitions. So you can never learn enough about this stuff. So here's an example of one of those. And as Brad mentioned, you can see the lawn was not cared for. This one had actually pretty decent bones to it. The inside needed some renovation. But this one was purchased in May of last year for $180,000. Required quite a few for the size of the house it was, about $54,000 renovations.
Well, let me explain. Yeah. This was a dirty house, and there was two different ways we could have gone with it. You can see on the outside of the home, what did we do? We just really painted the outside, cleaned up the landscaping, and I mean that's all that was done on the outside. We made a decision to upgrade everything on the interior. If we were going to rent this property, we probably would have just cleaned it up and left everything on the inside the way it was, maybe put new carpet and paint in there. But we made a decision to upgrade the kitchens and baths, and by doing it, the property sold in one day. So, it was a very positive move, but this was a great property. This is secret inventory.
You got it. Good stuff. Okay, our next piece of the puzzle, bankruptcy is another misunderstood animal.
So, when you hear the word bankruptcy, you think of a long legal process. When you hear the word short sale, you think of a long, drawn-out approval process. Well, I'm going to tell you one thing about bankruptcy properties. When you put the word bankruptcy short sales together, you have the shortest, fastest closings you'll ever have. And I want to tell you, I'm going to explain to you why. And this is another sleeper that nobody's looking at, very few people know about, and the people that do are capitalizing on these in a very, very big way. So let me explain the bankruptcy process really quick. When a property goes in bankruptcy, the courts appoint what's called a trustee. And the trustee's job is to manage the assets of that bankruptcy, and they're there to liquidate those assets, sell them to get money to pay off the debts of the estate, of the debtor. Now, the trustee's compensation is based on how much money they get in the estate to pay off these other debts. and they get paid upwards of 25%, which means if they collect $100,000 into the bankruptcy estate, the trustee puts $25,000 in their pocket. It's a significant number. It's a very, very well-paid position. Now, there's two kinds of assets in a bankruptcy. You have properties with equity and properties with no equity. The properties with equity, the trustees, you know, they're licking their chops when they see those properties, because they're saying, okay, if I sell this property, everything above the mortgage amount, I'm going to get paid 25% on. So the trustees will fight for those properties tooth and nail, drag them out in the bankruptcy process. When they finally get them, they're going to market them and try to get them and sell them for the highest dollar amount. You're going to see them, they're going to take them to those auctioneers that we were just talking about. And the auctioneers are going to market them and really ride them as hard as they can get to get top dollar. And the reason they do that is the more money the trustee gets, the more money he puts in his pocket. Now, let's go to bankruptcy properties with no equity, a bankruptcy short sale. So if a trustee has a bankruptcy and he has a property that's upside down, that property is a hassle to the trustee. And the reason it's a hassle to the trustee is because trustee looks at it and says, oh my gosh, I got to go through all this heavy lifting and this ugly legwork, and I'm not going to make any money on it. So we focus on properties with no equity on them, and we contact the trustees and we say we want to buy that property, and the trustee in most cases is highly motivated to talk with us. He wants to get rid of the property as quick as he can, and we submit an offer to the trustee. And what happens is the trustee is actually on our side. He's working for us. He then takes that offer and goes and negotiates with the bank. And the trustee has the power, in certain cases, of doing what's called a cram down and force the bank down, or secondly, going to the bank and saying, hey, this process is going to be a very long, drawn-out process. This is a very good offer. If you accept this right now, you can get out of this bankruptcy and get the majority, get a good chunk of your money back. So the trustee doesn't care how low the bank goes. They just want to get it off the books. So the trustees actually are working for you. So we love bankruptcy short sales. Absolute home run.
Yep, they are some of the best. And misunderstood. I think, Brad talks about bankruptcies. You don't need to be an expert at Chapter 7, 11, or 13. The question is the house included in this thing or is it not? And if it needs to be liquidated, is it one of those deals that we can get in there and strike those deals? Here's an example of one of those. Again, this is another one just in last year, purchased for $320,000. This one was a nicer neighborhood, basically, so $41,000. Did a decent job of just getting it to where it needed to be. Some minor upgrades on the outside. Listed at $609,000. We ended up selling it for $580,000 just a few months after the renovations were done. Nice profit on that one, $161,000. So it's out there. And the big question that everybody always asks about to us is, where do you find all the inventory? And I think we're sharing with you some really keen insights that inventory is either on the market, in which case it gets gobbled up pretty quickly right now, particularly with some of the big institutional buyers, or it's off-market. And it's the off-market deals that we spend our time researching. And as we've pointed out to you, because we do possess that data at foreclosure.com, we have the ability to capitalize on that. I mean, we practice what we preach. But one thing that you won't find on foreclosure.com are natural disasters. And these come sometimes few and far between. One of the best natural disaster types that we're familiar with living here in South Florida are hurricanes. And I know Brad did extraordinarily well back in the early 90s with Hurricane Andrew, and I participated in the days of Hurricane Wilma, which was in 2005. In those cases, you have very tight geographic areas that have high levels of destruction, basically, and although it's not a happy thing for the folks that go through it, the reality is it does need to be resolved. And the latest of which, I'm sure we're all familiar with, happened in October of 2012, and that was Hurricane or Superstorm Sandy. Brad and I have spent the better part of the last 18 months up and back from there watching the slow and painful progress in some cases for the homeowners, but from our perspective, watching the rapid progress of the infrastructure from plumbing to electric, all being upgraded in the Jersey Shore market, and that's on the Barrier Island as well as the mainland, watching these communities revitalize. And we just have so many things we could talk about this marketplace, but most of the structures there were built in the 40s and 50s. The vast majority of them, over 65%, are owned free and clear, or at least were owned free and clear, as these properties were passed down from generation to generation. And the demand for these properties has been pent up for decades. Well, now we're finding, after we did some analysis on this, over 300 homes affected, 89,000 houses suffered more than 51% damage, which is basically considered total as far as FEMA is concerned, many of which were underinsured. So natural disasters are an opportunity to mobilize a team, get in there, and boots on the ground. I mean, this is not like buying a giant development. You're going homeowner to homeowner and assembling teams of realtors and all that stuff. And it's really just an amazing opportunity. Some of the highest returns that we see are during these times. And again, I'm not suggesting that we go in there and take advantage of folks that are in a tough situation, but there are a certain number of people that flat out want out of those situations, and the only way that they can be helped is to have a cash buyer come in and strike a deal. So, anytime that we can help folks, in fact, I remember, Brad, you sent a couple semi-tractor trailer trucks up to Hurricane Katrina in New Orleans. We're there to help, but at the same time...
Yeah, we actually got there before FEMA.
Yeah.
We were doing a relief, a rescue relief, and we were trying to help out a baby hospital that was damaged, and we got 14 semis in there before FEMA.
Yep, and we talk to these folks up on the Jersey Shore all the time, and if you just read the news, or in fact, I think it's interesting to know, it's really not something you see a lot on the national news. We spend a lot of time digging down to the local papers, and folks are just still struggling with this stuff. And again, many of them are able to get some grants and subsidies to get them back in their homes, but it's a long-term issue up there. But I will tell you that some of the finest investment opportunities up there, and we'll go over a couple of those. I know we need to get iPlan group to talk a little bit about some of the financing here, but these are properties right on your island. This particular one we purchased for less than land value at $160,000. Properties on the Jersey Shore, the smallest bungalows typically sell prior to the storm for anywhere between $450,000 and $500,000, and now those prices are starting to creep up as the newer construction is coming in with modular homes, state-of-the-art green housing, et cetera. And as you'll see, the profits on these things tip close to $200,000 in almost every single case.
We're trying to buy as many as we can up there.
Yep, and there's more houses than there's money available right
now.
So you can see that the varying degrees. Now the market here in Ocean County today ranges from a resale standpoint anywhere from about $500,000 up to a little over $2 million right on the ocean. Purchase prices on renovated houses in the $750,000 to $950,000 occur right and left every single day. And that little map that you see up there shows you there's only 3 or 4 blocks on the barrier island that allows basically everybody to walk to the shore and or have boats on the bayside. So these are just really exciting times up there. So as we come in here, we're going to just cover 3 things, and I'm going to turn it back over to Aaron momentarily, but there's really 3 ways that we work as investors and that we encourage other investors to work. You can go buy properties yourself, and clearly the name of the game is to get educated, understand what it is that you're getting into, and become an expert in any of these different types that we're talking about, or to partner with another investor, in which case, Brad and I do that all the time, and that way you can leverage that opportunity from somebody, or to invest in a fund. And that is for folks who maybe don't have enough investment money that want to get involved in real estate. It's a great way to take passive money, whether it's from a savings account or the folks at the iPlan group will share with you some other angles of attack, and put those into a larger fund that's actively investing in properties and earning those returns. So I'm going to go ahead and pass the baton back over to Aaron. And Aaron, I think I need to go ahead and change presenter back to you, if that's okay. And there you are.
All right. Thank you. I'm actually going to turn this over to Matthew, and he can take you guys over on an overview of real estate through your IRA.
Patrick, really appreciate that, and Brad as well. Awesome, awesome stuff.
Thank you.
I can't wait to have you guys on for some additional training and really dig into these different, methods of buying this inventory. So it sounds a lot like there really is a lot of inventory out there still. There's just maybe it's off-market type of deals that is where the best deals are. Is that right?
That's a fact. Yep.
Exactly. There's inventory everywhere, and it's just knowing how to identify it how to negotiate, how to get to it, and how to negotiate on it.
Good stuff. Yeah, and so I think that's where our clients come in is, once they find that deal, the biggest question we get is, well, how do I transact it within my self-directed IRA? So that's what I wanted to, step in here and kind of teach on a little bit for a moment. I'll keep it real brief so we can do a little Q&A at the end with you guys as well. But, most of our clients are aware, but if there's anybody new on the call, anybody from foreclosure.com, I want to cover what an IRA is and what a self-directed IRA is more specifically. So, a self-directed IRA is basically an IRA that, it's going to allow you to move beyond your stocks, bonds, and mutual funds, the typical securities that you're used to buying inside of your IRA. And now you can use it to purchase real estate and some of these more of these distressed assets that we're talking about here on the webinar today. So really, you're making a portfolio work for you. So, some people buy all real estate in their IRA. Some people diversify and they'll still do stocks, bonds, mutual funds, and maybe half will be invested into real estate. But that's where we come in. iPlan comes in and we open the IRAs, transfer in the funds, and we allow our clients to buy those, alternative assets like real estate. So let's talk about the advantages of doing that. So number one, no capital gains on your profits. When you buy or sell a property inside of your IRA, it's either going to be a tax-free or a tax-deferred transaction depending on your account type. So that's huge, right? So you can do your rehabs, you can do your cash flow, maybe have a rental in there. The sky's the limit. And the cash flow on these properties, as long as you do it inside of your IRA, is also tax-free or tax-deferred. There's also no limit on holding property. I get this question a lot. A lot of clients come to me and they say, well, is this a loan? How long can I have the money out? The really neat thing is it's not a loan. When we transact these deals, we code these as investment transactions. So the money goes out for that purchase of that property or that tax lien or that promissory note or however you do it. And it can remain out of the account indefinitely because there's just a new asset being held inside of the account. Another powerful tool, IRAs can borrow money. So an IRA actually can go to a bank and borrow what's called non-recourse lending, and that's money that an IRA can borrow from an institution to go purchase a piece of property. We'll talk a little bit more about that later. And like I mentioned before, your profits are going to compound a lot faster inside of a tax-deferred or tax-free IRA because you're not paying that typical, what is it, 30, 35% or something like that. What is capital gains rates? Do you guys know what it is?
Well, yeah, there's short-term and there's long-term. Your short-term capital gains are 20%, and your long-term is upwards of 40%.
Oh wow. Okay, so I didn't even know it was that high. 40%. That's a lot.
Yeah.
So that's where these types of accounts really come into play, and they really save you a lot on taxes, and you can compound the balances a lot faster than if you were doing these deals outside of your IRA because you're eliminating that tax every time you do a transaction, every time you buy and sell per se. And then lastly, you have complete control over your retirement wealth. So you're no longer handing your account over to a financial advisor or putting it in a few mutual funds that maybe your old company 401k offers and hoping and praying that they go up. This is going to be something where you take control and you invest into what you know and what you're the expert in. So let's talk a little bit about the different ways that you can purchase real estate inside of an IRA. The number one method, and this is what we see mostly, is the outright purchase. So you take 100% of the purchase price, the cash comes out of your IRA, you buy the property, your IRA owns 100% of it. Partnering, where an IRA can actually partner with another individual, possibly another IRA or an entity like a company or an LLC. And then the IRA just owns a portion of that transaction or that deed. And then, like I mentioned before, you've got the leveraging. So, an IRA can actually take on a mortgage in a non-recourse sense, which non-recourse means that the bank's sole recourse is the property. They cannot come after the account holder or the IRA. And it's good to know that they do typically want, 30, 35, sometimes 40% down. So it is a little bit more stringent there. But and lastly, whenever you do leverage your IRA, it does trigger a tax called unrelated debt-financed income. So it's a tax that gets, it comes into play on a portion of your profits if you do use the leverage. So if you use that method, of course, talk to your CPA or your attorney before you get into it. But it is an option. You can, borrow money to do a transaction. I'll talk a moment about what you can purchase, and there's a whole slew of different investment opportunities out there, but for the purposes of this webinar, we'll just talk about the types of real estate. So we know that we can get into foreclosures and pre-foreclosures and short sales. Now we know how we can get these deals, but there's also different types of deals out there. So you've got obviously your residential and your commercial, which we saw a few examples there earlier. But you can also get into raw land or options, mobile homes, lease options, rehabbing. Rental properties are real big inside of an IRA. Subject tos, farmland. We've got clients that have bought, property here in Ohio, and it has mineral rights, and those mineral rights come back to their IRA tax-free or tax-deferred. So it can be, real estate inside the United States, foreign real estate, REITs, promissory notes backed by property. I mean, the sky's the limit. If you can show title to it, typically you can hold that inside of your IRA. So let's talk a little bit about the basics of an account and what we offer here at iPlan Group. So we do mainly deal with IRAs, but we also do offer a plan called a solo 401k. But on the tax-deferred side, we've got the traditional IRA, the SEP, which is a small business plan, the Simple, which is also a small business plan, and then a 401k or a solo individual 401k for sole proprietors. And then on the tax-free side, we've got the Roth account. That's an account that you can grow tax-free. You can also pull contributions out tax-free on. We have the CISA, which is the Coverdell Educational Savings Account. That's an account that you can put away $2,000 a year into to grow for your child's education expenses, and you can pull that money out tax-free as well. And we have a health savings account, which also has tax-free distributions as long as you pull it out for certain medical expenses. So it's really neat. There's a lot of different accounts here that a lot of people don't know that you can self-direct, and you can. We offer these. And so these are accounts that you can open up and start buying alternative assets in. Funding options, another very common question or theme, I guess you could say, is how do I transfer over money into my account? Typically what I see, most of my clients have an old 401k or 403b or some sort of qualified plan that an employer set up for them, and in that case we do a direct rollover where we go to the other institution and pull the money over. We can also do direct transfers from an IRA, so we go to one IRA custodian and send them transfer paperwork to move the money over directly from them to us here at iPlan Group. You can also do a conversion, which is basically a client taking a tax-deferred plan, converting, paying the taxes, and moving it over into a Roth. We can do contributions, where a client can send in their annual contribution into their, let's say, their traditional or their Roth, and those contribution limits are $5,500 a year on those accounts, $6,500 if you're 50 or over. And you can do, well, there's a few other things too. You can inherit an account if you're the beneficiary on it, and there's also the Quadro, which is basically a qualified, I believe it's qualified domestic relations order where a judge splits assets in the case of a divorce. So there's a few different ways that you can transfer money in or contribute, and just wanted to kind of give you an overview of some different methods of moving money into a plan. And this is something that I can cover more one-on-one with clients on a on a strategy session to talk about the best way to move money over for their account. Okay, so we'll kind of tie things up here with what you can and cannot do with an IRA. Clearly we can buy real estate, we can do notes, we can do tax liens, but I wanted to talk for a minute about prohibited investments, just so you know what the IRS states that you cannot purchase. And thankfully the list is really short. So they list 3 things, and it's life insurance, subchapter S corporations, and then collectibles. And the collectibles can be pretty broad, but anything like artwork, rugs, antiques, metals, gems, things of that nature. Unfortunately, you can't put that inside of your IRA. Other than that, other than those three categories, if you can, show title to something, I mean, typically you can buy that with your self-directed IRA. So my point here is the IRS doesn't tell you what you can buy, they only tell you what you can't buy. So that leaves the door open for these other alternative assets that we're talking about today on this webinar. A couple of things you cannot do with an IRA, prohibited transaction-wise. You can't borrow money from your own account. You can't sell property or transfer assets between your account and your IRA and vice versa. You can't receive unreasonable compensation for managing it. You can't use the account as security for a loan. So let's say you're buying a business. You can't offer your IRA up for collateral. That's a prohibited transaction. And you can't use any of the property or the assets in your account for personal use. So these are the main ones. I encourage clients to look up, IRS publication 4975, or even just Google prohibited transactions to get a more in-depth, overview of that. And it's something we can talk, through on the phone as well. But I wanted to give you a brief overview of some things that you cannot do with your IRA. So again, no borrowing money. You can't sell property or transfer assets between you and your account. You can't use the property or the assets in that account for personal use. And you can't benefit from, let's say, a piece of real estate in that account in any way. It has to be for the sole purpose of benefiting your IRA. So you can't benefit in any way now, except for in retirement when you, obviously take your normal distributions. Disqualified individuals. These are the people that you cannot do business with. So when you go back to that other slide about the prohibited transactions and things you can't do inside of your IRA, this includes these individuals as well. So these are people that you really should not transact business with in regards to your IRA. So you, as the account holder, are a disqualified individual. Also your spouse, any lineal descendants, so people above or below you on the family tree, parents, children, grandparents, grandchildren, and then fiduciaries, investment advisors, someone that you pay for investment advice. These are people that, you shouldn't transact business with in regards to your self-directed IRA. Lastly, there's corporations that you own 50% or more of, and anyone providing services to you, to your IRA, such as a trustee, administrator, or custodian, somebody that holds your IRA plan. So those are the last two categories of disqualified individuals. So again, if you own 50% or more of a company, then you cannot transact business with that company in your IRA, and then you cannot, per se, do an investment with somebody that works at a administrator, custodian, or fiduciary, somebody that holds your plan for you. So that's it. Real briefly, just wanted to go over some of the highlights and some of the rules and account types in regards to self-directed IRAs. I can always be reached via email or phone, and we're going to put up Brad's information, Patrick's information, and mine all together. So, guys, thanks a lot for coming on and doing this webinar. I know we're going to do a lot more training in the future, so I'll go ahead and then open it up for some Q&As. I know we've got some clients that are raising their hands already.
Hey.
All right, we do see here one person asked if they are saying that they were unable to join on time. Will we be doing a replay of the webinar? We will receive a recording of the webinar within the next couple of days, so we will email it out to all of you. That way you actually have the recorded version of it. I know a lot of you are, calling into this webinar while you're at work, or maybe you're at home and busy. So we will be sending you a recorded copy so that you can just replay it as needed. Somebody else asked, and Patrick and Brad, this is more towards you, they asked if you offer a classroom type training. It looks like he is interested in tax lien and tax deed sales. Do you offer any type of classroom training?
We do periodically. Generally speaking, when we do that, it's in conjunction with another event. For example, this Hard Money Conference. We did some live training at that, sometimes during the mortgage banking conferences. Or if there's a group, for example, maybe an employer group or a real estate investment club or something that has a large enough critical mass, and that might be 30, 40 people or whatever, we certainly are open to doing live events.
But if you want more information on it, just reach out to us, send us an email, and we will get with you and get you more information and work with you.
And I know that Matthew and Aaron are planning some additional training courses which will be live via webinar again, and although you won't have us in the flesh there, you'll certainly have us live and in person as we're doing here, which is more economical for everybody involved.
Absolutely.
Okay, so we've got one question here from Patricia. She says, in California, in order to purchase a property on the courthouse steps, you have to bring a cashier's check. Is there a way to use your self-directed IRA?
Yes, Patricia, there is absolutely a way to use the self-directed IRA to do that. There are a couple different options. I would definitely suggest signing up for one of our free IRA strategy sessions. When it comes to doing it on the courthouse steps, it gets a little bit more detailed because of the different ways that you can do it. There is just a simple form that you can fill out prior to the courthouse, prior to the actual auction. You would basically tell us, you know, the top amount of money that you would need to send, the top amount that you'd be willing to bid on, and we would write you a check. And then as long as the courthouse is willing to reimburse any overage, if you win that bid or multiple bids, you can use that check and have them reimburse the overage to the IRA. Now, some courthouses don't do reimbursements of overage, so there are a couple different options and ways that you can do it differently in order to have that check with you when it comes to that. It would take a little bit longer to explain, so I would definitely suggest signing up for a free IRA strategy session. Just visit our website. You can see it there on the screen, iplangroup.com/strategy. And it looks like we have another question coming in. Let's see, why buy real estate with an IRA when you can't deduct the expenses?
That's a good one, and I get that a lot. And the main reason why is because, you know, you don't have any taxes to deduct against. So usually when you want to use deductions, it's because you're trying to lower your taxable income for the year. But you have to look at yourself and your IRA as completely two separate entities. So you wouldn't be able to use your IRA's deductions for your personal taxes. But in the case of the IRA, it doesn't need any deductions because the IRA is a tax-exempt entity. So there's really no taxes to write off against. So you know, there's nothing. You just don't need to take any deductions.
So while we're waiting to see if any more questions come in, I'm sure you can all see on your screen that Patrick and Brad of foreclosure.com are offering a free 2-month membership to foreclosure.com. Just give them a call and they can get that fee waived for you. And like I mentioned, we are still offering free IRA strategy sessions. It's just typically about a 30-minute phone call where we kind of discuss all about you, what your goals are, what your investment history is, and we kind of work with you to determine the best strategy moving forward in order to help you increase your retirement wealth. It looks like those are all the questions that we have coming through. Like I said, we'll be emailing everybody out a copy of this, and then Patrick and Brad have also offered up a copy of their presentation. So we'll include that in the email in the next upcoming days as well so that you have that there. And if you have any other questions, you know, take record of our information and follow up with us. We will give you a free strategy session, and Brad and Patrick are as well. Oh, you know what? And we have one last question coming in. Can you make reasonable compensation for working on flipping properties within the IRA?
The answer is no. No, unfortunately, you cannot have any personal benefit in regards to doing a transaction inside of your IRA. So reasonable compensation, that's more so geared towards somebody who is their own CPA or their accountant, somebody that's doing their own bookkeeping work. That's something you talk to your accountant about. But in regards to compensation for doing an actual deal, an investment transaction, you could never personally benefit.
All right, it looks like that's all we have for today. Patrick and Brad, I really want to thank you for this high-level overview that you've provided. I think you provided a lot of really great information, and hopefully everybody can use this moving forward and increase their wealth through their retirement and otherwise.
Yeah, guys, check out Brad and Patrick with foreclosure.com. Again, guys, thanks so much for coming on today. We look forward to doing some more training with you in the future.
We do too. We greatly appreciate it, and we welcome any phone calls with any questions that anybody may have.
All right. We're going to go ahead and close the webinar now. I hope everybody else has a great rest of the day.
Thanks, everybody.